Hey everyone, and welcome to FinTech. I just sold part of my Zoom position, and in this video I'm going to be explaining why I sold, what I'm going to be watching for coming from Zoom going forward, and how I can square this decision with the fact that I made several videos just a few weeks ago where I was much more bullish on Zoom. This may be a bit of a shorter video since I just wanted to update you on my current thoughts on Zoom, so stick around until the end so you don't miss any useful information. So hit the like button and don't forget to subscribe, and let's first get into the reasons on why I decided to sell. Now, to be perfectly clear up front, I did not sell all of my Zoom shares. If you watched my previous monthly portfolio reviews, you'll know that Zoom was my largest position by far, at one point being worth 50% more than my next largest position. But in my last analysis of Zoom's Q3 reported earnings, I noted several risks which Zoom was going to be facing in the short-term future. In the face of these risks, I decided to shrink my Zoom position to bring it more in line with the size of my other stock positions. I tried to bring it down to a bit more manageable level by selling off 30% of my total Zoom position. So what were these risks that I was seeing for Zoom, and why did they cause me to sell the stock now? The biggest risk is obviously with the release of the vaccine in Europe and the United States over the next several months, we may see an end to large-scale work from home. While I do think there's going to be a continued need for Zoom's platform far into the future, Zoom is going to lose customers in the short term because people are not going to use Zoom as much when they can see each other face to face. I am very optimistic that this drop in users is not going to ruin Zoom as a company, but it is still a risk, and so it needs to be factored in when deciding how much money to allocate to one stock position. The other risk that I see is whether or not Zoom will be able to move from being kind of a one-trick pony company that only sells one product to an actual corporation which sells a whole suite of products that their customers can use. Now, while there are already products in the works such as Zoom Now and Zoom Phone, the company is going to have to bet pretty heavily on these new products to generate the same kind of revenue growth that they've seen in the past. Zoom Phone in particular is going to need to show some pretty good numbers in order to boost Zoom's revenue in the short term. Now, on their last earnings report, the CFO declined to answer any questions specific to the numbers around Zoom Phone, but he did say that this was going to be a significant part of their revenue growth going forward. Now, in the past, Zoom has been growing its revenue at around 80% per year. Zoom's Phone is going to need to be a huge success in order to keep up that growth rate, especially considering the larger scale that they need to operate at now. It's a lot easier to grow a small company 80% than it is to grow a big company 80%. I do think that Zoom's leadership, and especially their CEO, Eric Yuan, have a good vision for Zoom in the future. And I think that in the long term, they're going to be very, very successful. The question is, over the short term, in the next several quarters, will the products that they release be enough to make the same kind of splash in the market that Zoom's original product did? I'm not 100% sure either way, and so again, that's just a risk. Going forward, I will be watching the numbers on Zoom's new users, how quickly they're onboarding their customers to new products, as well as how well they're expanding into new markets. Europe, the Middle East, and Asia represents a huge opportunity for Zoom to continue to grow outside the United States. They've already been doing well, and they have a strong foothold internationally, with 30.7% of their total revenue coming from international customers. They also managed to grow 5% last quarter despite loosening lockdown restrictions in Europe. But again, while these markets do show promise for Zoom, it's not 100% certain that their international growth is going to match the growth that they've experienced in the US. And so because of that, there is still the risk that this market opportunity might not be as big as they think it will be. So I've laid out a couple risks which are going to be facing Zoom in the future, but in my opinion, these risks alone aren't enough to warrant selling off my Zoom position. I do think that 5 years from now, Zoom is going to be worth more than it is today. I'm not worried about the stock price crashing or anything like that. Instead, my decision to sell some of my Zoom stock is based purely around the idea of opportunity cost. For those who don't know, an opportunity cost is simply missing out on a potential gain because you chose an alternative choice. So if, for example, I decided to go to Burger King instead of McDonald's, I would be missing out on the opportunity cost of getting a delicious McRib from McDonald's. And yes, I am on Team McRib. In stocks, the opportunity cost is the amount of money you miss out on by having your money tied up in one stock position when it could have been invested somewhere else that would have made you more money. So for example, even though my stock portfolio has performed really well this year, it would have performed even better if I had just taken all that money and dumped it into Tesla at the beginning of the year. So all the potential gains that I missed out on Tesla was an opportunity cost for staying invested in my stocks. So with Zoom, me trimming my stock position is not because I think Zoom's stock price is going to decline. It's because I think that there are other companies which are going to outperform Zoom, at least in the next couple quarters. The main reason I shrunk my Zoom position was to give me more money to invest in two other stock positions that I have higher confidence in: Cloudflare and Datadog. I don't want to get too into the weeds on what each of these two companies do, but here's a quick summary of each. Cloudflare is a competitor to Fastly, a company which got a ton of coverage on YouTube a couple months ago, but which I actually sold out of around that time in order to buy into Cloudflare. It's hard to nail down exactly what Cloudflare does because they have their hands in so many pots. If I had to describe what they do in one sentence, they basically make the internet better. They host websites, making them more secure and more performant than other CDN providers. They host edge computing, which is both cheaper and has better performance than even giant cloud providers like AWS. And they continue to innovate and pump out successful product after successful product like clockwork. This has allowed Cloudflare to not only grow at scale, but to actually accelerate their rate of growth in the last few quarters. Datadog is a similarly strong company, which has profited off the fact that there's so much more data being produced as companies move their infrastructure to the cloud. What Datadog does is build tools that allows companies to unlock the trapped value within their data, which is normally siloed in different parts of the company. Datadog allows these silos to break down by letting companies view their infrastructure, application, and security data all through a single pane of glass so that they can gain insights from that data which make them more money. Even while facing headwinds from companies cutting expenses over the last few quarters, Datadog still managed to grow 10.7% last quarter, or a total of 61% year over year. And it has the potential to grow much more than that once the world starts opening up again. This at least beats Zoom's projected growth rate of only 4% next quarter, and even though I think that 4% number is kind of sandbagging and I think it'll be a little bit closer to 8%, that's still underperforming what Datadog is doing right now. I don't think there's a wrong decision here in terms of losing money on my investment. I just think that while Zoom might perform well if the risks that I laid out earlier don't come to fruition, I have two companies that already are performing well, which see nothing but blue skies and runway ahead. So to fully lay out what moves I am making, I have reduced my Zoom stock position by 30%, and I've split that extra money between Cloudflare and Datadog. This is a reflection of short-term risks facing Zoom, so there is the potential that I will need to make other moves very quickly in this stock. Now, I don't think that anybody is really copying my stock portfolio at this point, but this is a good reason why you should never try to copy someone else's investments, and you need to understand for yourself what would cause you to either buy more of a stock or sell it. That way, when that time comes, you're ready to take the appropriate action. With that said, I hope you enjoyed this video. If you did, make sure to leave a like, and if you don't want to miss out on any future videos, make sure to both subscribe and hit the notification bell. I'll see you next time.